Look at a long-term price trend on a chart, and it may appear to be the result of a gradual, collective shift in retail sentiment. However, a close analysis of order flow reveals that these movements typically have a more localized and specific origin. Most structural trends initiate via a violent, intentional liquidity imbalance. This kinetic displacement, visible here as a sudden eruption from a balanced field, forces a directional regime shift that traditional random walk models cannot account for. This initial localized displacement is the genesis vector, mathematically categorized within this framework as wave A. Wave A is more than a directional indicator. It functions as a mathematical architectural blueprint for the entire market cycle. By locking this breakout bar into a measurement framework, we quantify the move's internal physics. Deconstructing this vector establishes a macro invalidation floor at the move's origin and projects forward targets into previously empty space on the chart. Mastering the genesis vector allows for the separation of true structural momentum from the statistical noise of a mean reversion trap. A valid breakout requires a specific structural precondition. The market must first be locked in a state of extreme order book equilibrium. On a chart, this equilibrium manifests a severe volatility compression. The moving averages fuse into a tight horizontal baseline. While price remains flat, the volume profile below swells, revealing large-scale block orders quietly accumulating contracts. This absorption creates a pressure chamber. As more orders are filled without moving the price, the potential energy of the eventual breakout increases. Retail algorithms often misinterpret this phase as a dead market. They overlook this structural buildup because the price action lacks visible direction. Paradoxically, this state of absolute surface-level flatlining represents the moment of maximum kinetic potential in the market's microstructure. The transition from equilibrium to a directional regime is triggered by an ignition catalyst, a localized liquidity shock, where an institutional order size exceeds the available resting liquidity. This shock consumes local orders, shattering the gray compression cage into new territory. Moving averages detach from the baseline, fanning outward sequentially. The exact bottom of this candlestick becomes the valuation 0 point, marked by a bright diamond anchor. This coordinate is the mechanical anchor for the expansion's trajectory. It provides a binary risk rule. If price retraces and closes beneath the 0 point, the trend is structurally corrupted and no longer valid. Identifying this exact coordinate is a prerequisite for determining risk exposure. Without a 0 point, there is no mathematical basis for a systematic trade. While the 0 point marks the start, the peak of the impulse defines the vacuum vector. The point distance from the 0 point to the climax of the impulse serves as the master measuring stick. This vertical vector quantifies the entire initial surge. The length and speed of this vertical vector provide a direct measurement of the commitment behind the move. A deep, fast vector creates a liquidity vacuum that price is likely to fill later in the cycle. Quantitative models use this specific vector distance to project coordinates for future algorithmic liquidations. By mapping a 1.618 geometric extension of this vector, we create forward-looking grid lines that identify future profit-taking zones. These coordinates act as future resistance points because they represent the levels where automated systems are programmed to exit positions. A macro trend is not an unguided evolution. Its eventual destination is mathematically bounded by the magnitude of its initial impulse. The genesis vector presents a paradox. Its high visual velocity is necessary for a trend, but that same velocity creates a significant mathematical risk for those who enter late. Late operators often suffer from FOMO, attempting to buy into the trend only after the momentum has reached its climax. This leads to the hydroplane trap. Here, price accelerates more than 3 average true range multiples from the baseline. The empty gap between price and the baseline indicates lost structural traction, like a car lifting off the road. When buy volume pauses, mean reversion gravity pulls price down. Entering at this peak creates a mathematically hostile profile. Your stop loss remains below the 0 point, resulting in massive risk for tiny reward. Peak visual velocity does not indicate structural strength. It signals a state of maximum mathematical risk. The life cycle of the genesis vector is defined by the transition from perfect equilibrium into a measurable kinetic imbalance. Stripping away the complexity reveals the core utility of Wave A. It provides a fixed invalidation floor and a set of rigorous algorithmic targets. Systematic trading requires either capturing the ignition cross at the valuation 0 point or refusing to enter once the price has detached from its structural support. Choosing to bypass a hydroplaning market preserves capital for more favorable conditions. Success in this phase relies on waiting for the vehicle to downshift into a pullback, where structural wholesale value returns. An explosive breakout provides regime clarity, but successfully extracting alpha from that breakout requires maintaining strict discipline over its mathematical boundaries.